What is going on, everybody? I hope everybody's portfolio is doing well. The market is at all-time highs. It's not a better time to be in the market. And we're going to talk about whether or not is this the time to sell, take some money out of the market and play it safe, or just let it ride out and maybe we'll keep hitting all-time highs. So before we get into that, I want to cover Lyft earnings. So they reported earnings on Wednesday of this week, so a couple days ago. I think it was Wednesday or Tuesday, something like that. Um, but Lyft is a company that I'm pretty bullish on. I haven't covered them yet in a YouTube video. So if this is your first time listening, I'll kind of go over it. Um, their earnings and just why I think there's a lot of upside with them. So where Lyft stands right now, by all means, obviously you look at Uber, they're the industry leader. It's not even close. The scale between Uber and Lyft, it's not even close. Now, I don't think Lyft will become an industry leader, but I do think right now there is opportunity with them, and I think they're just undervalued. So right now they're sitting at about 5.6 billion market cap right now. I think it can get to 10. I mean, easy. I think it can get to 10 easy. Now where it's at, I think the price right now, I mean, it was literally just actually right there, 13. Yeah, it's a little under $14. So I think right now for what I think the company is worth right now, I think it's worth around 18 to 20 bucks right now. Now I think it can get to 30. But right now, fair value and where they're like what they're worth, I think 18, $20 is where they really should be. Um, and I think the market's at all-time highs, right? Or almost at all-time highs. It's sitting around those levels. We could have threw now back when we had those tariff dips back in April, you could have really threw your money at anything and you would have made, you would have been up 40, 50%, whatever. But the thing right now is and this is where like stock picking becomes a little hard, right? Because when you're sitting at all-time highs, you have to be able to find companies that are still undervalued and in seeing plays that the market isn't seeing. And I think that's what this is. I think this is what's happening with Lyft right now. So I want to just go over some of the stuff um, that they announced for Q2. So record gross bookings of 4.5 billion, that's up 12% year over year. Revenue hit 1.6 billion, up 11%. Net income 40.3 million compared to 5 million of Q2 2024. I don't really care about EBITDA too much. Record free cash flow of 329 million compared to 256 million in Q2 of 2024. Last earnings report that they announced that they approved a repurchase program for their stocks. So they purchased about 200 million, which I think is very, very good to see whenever you have a management team that's very confident in their stock or think it's undervalued. So that's always good to see. Putting some cash to work and trying to provide some value for the shareholders. So recently, they also announced partnerships with Baidu, I don't even know how to pronounce that, and United Airlines. I think Baidu is interesting, and if you're not aware, they did acquire a company called FreeNow. So this is basically giving them or expanding their total addressable market in Europe. And they're partnering with Baidu to bring autonomous vehicles over to Europe. So it's not like they're going to be left behind. They're not trying to take advantage of this whole autonomous vehicle boom. They have all these partnerships. You can see right here that they're always trying to find the best partner and really try to take advantage of this. So this is the company down here that they acquired, and I think they're doing the right thing. Right, they're not going to keep their business solely inside of the U.S. They're trying to go over to Europe, and I think they're making the right partnerships. Again, I think Tesla and even Waymo's starting to take a little bit of market share in certain cities. But it's not about Lyft, and I think that they're going to rise to the top of this industry and completely take over. It's just a matter of, I think it's undervalued and I think it can double from its current levels. So my favorite thing about Lyft right now, so you can see their quarterly rides hitting all-time highs, quarterly active riders all-time highs, gross bookings all-time highs. This chart right here is my favorite thing about them. The free cash flow is the most important thing that I look at when it comes to a business, because if you have no cash, then you're not going to have a business. This chart looks amazing. Amazing. You can see once Q1 of 2024 ended, that's when things really started to kind of just reverse. And this is a really good thing to see when you see this chart like this with free cash flow. So they're about to hit $1 billion in free cash flow, right? And this company is worth 5.6 billion. That's like a five price to free cash flow sitting at 5, which is insane. So I think that alone makes me pretty bullish on them. And here's some Q3 guidance. They were able to give some decent guidance. So gross bookings, again, expected to grow, hit all-time highs, as high as 17% to grow year over year. Here's their adjusted EBITDA. Here is their EBITDA margins. And then I also like this. They're still on track to achieve the targets that they laid out back in 2024 on Investor Day. So they're doing really good stuff. I'll keep covering them, but really solid quarter for Lyft. All right, so now we're going to get into just like the market, where we're sitting at, and where I think we're going to kind of be a few months from now. So I want to start out with this video. I don't know if the sound, I mean, it's like 13 seconds. It's nothing crazy, but you can kind of see 82% of S&P 500 companies beat quarterly earnings estimates, despite all of these tariffs that are going on, all the tariff noise. If you were following me back in April, the tariff war, whatever was going on, was just only a dip buying opportunity. So despite all of that, the numbers don't lie. 82% are beating their estimates. And they're also raising their guidance or reaffirming and maintaining that guidance that they gave in the beginning of the year. So I don't know if the sound is on this, but I'll play it.
With 82% of S&P 500 companies beating estimates so far. That's the highest rate since 2021.
So I don't know if that was on, but this is the highest percentage of companies that are beating estimates since 2021. So that's pretty crazy to see. So that's one catalyst. And if you go through Perplexity here, so since this earnings season started, I've been kind of just going through every day, looking at all of these companies and just kind of skimming through here. All I've been seeing is companies that are beating their guidance, right? And they're raising their guidance or just reaffirming their full year guidance. So you can see right here, Alliant Energy, they reaffirmed their 2025 guidance. What else? This is off the top too. So I didn't double check this before, but pretty much like all of earnings season, I was just going down this and just seeing that like all of these companies, like right here, Eli Lilly, they raised their 2025 guidance. Like, in its different sectors, it's not just a specific sector like technology that's raising. It's multiple sectors across healthcare, industrials, tech. It's multiple sectors, and that's a very bullish thing where it's not just one sector. Constellation Energy, they reaffirmed their 2025 EPS guidance. So again, it's a very good thing to see. So that's the next or other catalyst that I think is going to help maintain that strong second half of 2025. We're approaching weak seasonality throughout the year. So like August and September are like pretty much the weakest months out of the entire year. So we may get a dip, but again, it's all good. So this came out today. TSMC hits a record $10.8 billion in July sales on the AI chip surge. So I made a few videos on this, short form, on why I think, this AI boom isn't over. And I'm going to be honest, at the end of last year, 2024, like middle of 2024, I really didn't, not that I didn't believe in it, but I didn't think it would get this insane. And just the amount of money that's being thrown at artificial intelligence infrastructure, data centers, chips, all of it. It's insane. And it's only, I think this is just the beginning. And this is going to keep sparking growth. I don't know how long. I don't think anybody knows how long. but we're going to keep riding that wave until it's over, right? You're like, this company is still growing in like the mid 20s, and they're a large company. So you have all these companies, the hyperscalers. You have Meta, Google, Microsoft, Apple's starting to get into the mix, and they're supposed to be investing like $600 billion into AI infrastructure. It's just, again, this is just another catalyst that has to make you bullish long term, and not be short sighted and get thrown off by all of the nonsense that kind of like you hear on the news and everything. I mean, look, the numbers don't lie. You have all these companies that are going to spend tens and tens of billions of dollars of capex per year on this stuff. It's no joke. So you have to be on the other side of that and invest in these companies that are going to be on the receiving end of this money. So this is another huge catalyst for the markets. The other one, and you might have saw it, but the September Fed meeting. So August, they have off all of August, so there's no Fed meeting for August. So they come back in September. So we had jobs data come out a few weeks ago. I think it was like a couple weeks ago, might have been last week, and they revised like 2 months of jobs, and it wasn't good. When that came out, this probability of a rate cut spiked up like crazy, and there's an 89% chance that the feds are going to cut interest rates by 25 basis points, so 0.25%, which is a good thing. And this is CME Group. They're just pretty much like 100% spot on. I've never really looked at this, and it was ever wrong. So most likely, as long as we just maintain our jobs data, CPI, all that stuff, then we're going to get that rate cut. You already know what happens. You've seen back in 2020, 2021, when we start to get lower rates, money becomes cheaper, people start to get on leverage, they start to borrow money, things can get insane. So again, I think 400 to 425 is still a little high, but you already know the current administration, they're calling for, they want rates to be at like 3%, maybe even lower. But you can see October, there's a 57% chance. So we have a chance to get back-to-back rate cuts. And then here's December right here. Back-to-back. So 3 in a row. We're supposed to get 3 cuts in a row going according to this. 3 cuts in a row. We're going to be below 4%, which is massive. We're entering some bullish times, and that's all I can say. It can get crazy over the next few years. And then lastly, this is pretty much like all you need to see. Sam Altman, so he tweets out a lot and about like, just what's going on with his business and chips and GPUs and all that stuff. You have the owner of OpenAI tweeting, we will cross well over 1 million GPUs by the end of this year. And then you have companies like Meta, Mark Zuckerberg's announcing that he's supposed to be buying a ridiculous amount of GPUs. Like, this is all you really need to see when you have CEOs of some of the biggest companies right now that are on the forefront of this AI boom tweeting this out. That's all you really need to see just to stay bullish on this. So this brings me to the question, is this the time to sell? I think so. If you're in it for the long run, for 5 years, you don't have to sell. I think you just keep your money in, stay patient, add on the dips, and your portfolio is going to keep going up and up. But with that being said, it doesn't hurt to take profits and just keep building that cash position up, right? So if you're up 50%, 60%, 70%, 100%, 200% on a position, it never hurts to just take some cash and just keep building that stockpile up, because when we do get a dip in the future, whether it's a 5% dip, a 10% dip, as much as a 20% dip like we had back in April, having a big cash pile always comes in handy. And that's what makes us, that's what separates the winners from the losers in the market, is always having cash on hand, buying on dips, and then you're going to literally see your portfolio keep growing and growing and growing on those dips. It's very hard to pick stocks out when the market's at all-time highs. You may get 15, 20%, but to get those 50%, 100% plays, you have to have cash on the side and buy during the dips, right? Because again, when valuations get far stretched and we're sitting at like 30, 30 PE on the S&P, and all these companies are a little overextended, it becomes very hard to get those 50 to 100% gains. So that's all I have today. I hope you enjoyed this video. Make sure to give a thumbs up and let me know in the comments if you're selling or if you're going to continue to buy. I'll see you in the next one.